Welcome to the Wealth Initiative. This is from the cradle to the grave, right? I'm Terry Lenoir, financial strategist, helps individuals create wealth by real stories, real examples, real wealth, and real solutions. All right, so we're going to start with Ask Terry. So a friend of mine, Warren, down in La Habra in Southern California, asked a question. He wants me to explain the difference between term insurance, whole life insurance, and universal life insurance. Very simple. I can explain that. All right, so we're going to do an apples for apples comparison. We have a husband and wife. They're both 30 years old, and we're going to show you the difference between having $150,000 worth of whole life on each, $150,000 worth of universal life on each, and $150,000 worth of term insurance on each. Now let's take a look at the difference. You have John and Mary, $150,000 worth of whole life insurance on each of them. That's going to cost them $295 per month. After 35 years, at the age of 65, in that cash accumulation that the agent sold them on, they'd have $124,000 total. That would be total what they have between the both of them, right? Remember, they had each $150,000 worth of coverage. Now, if we take a look at universal life, John and Mary each have $150,000 worth of coverage. That is going to cost them $318 per month. In that, universal life is expensive because the cost of insurance goes up every year. With that, typically, the cost of insurance will exceed what they're paying. It will also begin to eat away at any cash that they've begun to accumulate. So by age 65, they could very well have zero in their cash account. Now let's take a look at term. We took a look at $150,000 worth of term insurance on John and $150,000 on Mary. The cost for that would be $68.35. That would leave, respectively, $226 compared to the whole life, and it would leave $249 in additional income compared to the universal life. So that would be a savings if they put that difference of cost into an investment. Let's call it a Roth IRA. If they did that for those 35 years, they'd have respectively $685,000 or $745,000 respectively in the term insurance and invest the difference option. So, what's the best? Take a look. Would you prefer to have $124,000, zero, or somewhere above $685,000? The choice is clear and it's yours. Let's move forward and let's talk about the plan and the problem, right? And so we're going to cover some aspects of life insurance and the importance of having it. Now, realistically, most individuals are not clear on the purpose of life insurance. Life insurance is designed to replace your income in the event that you die too soon. And what does that mean, die too soon? If you die prior to having your wealth accounts established, right? So we all want to make sure that we get to retirement age or whatever age we look at where we no longer have to work for money. So if that's 65, 67, we want to have enough cash that we can live on. So at that point, our need to build wealth is pretty much come to an end. So we want to build wealth prior to that. And prior to that, we want to have life insurance to protect our loved ones in the event that we pass away before continuing to build that wealth. Now, we talk about the cost of living. We know that that goes up every year. When someone passes away, the cost of living continues, right? So we recently underwent a heartbreaking tragedy in our family. My grandmother passed away. She was visiting from Southern California up with my wife and I in Northern California. The cost of getting things taken care of became very expensive very quickly. We had to pay for the cost to transport her body back down to Southern Cal. There were other things that involved in that. We had to actually have her embalmed prior to shipping. We had to pay for permits, plane tickets, and the overall transportation of getting her to the airport. So all of those costs were super expensive and were unplanned for. No one thinks about those things. And then we talk about, the cost of dying. So the funeral, the casket, the opening and closing of, the burial site, the flowers, the priest, the musicians, everyone has to get paid, right? And so because of that, it gets very expensive very quickly. And therefore, you got to make sure that you have enough to take care of those final expenses for your family. So in California, the average funeral cost, and I'm talking bare minimum, we're talking about $15,000. And that's bare minimum. That is pretty much going just the basics, just the service, very little fanfare. We get to emotional in the sense to where we want to spend more money because we feel that that's going to show our loved ones that we care more about them. When, in actuality, if you have a plan, you definitely want to make sure you have things in writing and kind of establish that ahead of time. So sit down with your family, create a game plan, and then make sure that you have enough coverage to take care of. So the realistic cost, at the end of the day, the average person's going to spend anywhere in the neighborhood of 20 to 30 grand on a funeral when it's all done, because you're paying for all those extra things, including the obituary and all of the food at the repast, the hall, or wherever you're going to have the repast. 20 to 30 grand is a realistic number. And so when we talk about the cost of living, we talk about the loved one has passed away. If that loved one was contributing in any way, the cost of living continues, right? So the mortgage continues. If you had a husband and wife and the husband passed, the mortgage continues. All the utilities continue, right? The child care, planning for college, health insurance, car insurance, all of those things continue to exist and continue to need to be paid. And therefore, the cost of living can quickly get away from the one that's left behind. And if you don't plan, then that person can find themselves in trouble, needing to downsize, needing to, maybe get a second job, things like that, maybe even a third job. And so it makes it really uncomfortable when you don't have life insurance, you don't have enough to take care of your family, to replace your income in the event that you die too soon. The experts in the industry say that you should have anywhere from 8 to 10 times your annual revenue. Typically, what that will be able to do is put your family in a position where you'd be able to replace your income. It needs to be managed properly, but they'd be able to replace your income for the next 20 to 25 years, right? If you do it right, that money can last you the rest of your life if it's structured properly by a professional. If you don't do that and you don't have enough coverage, then you find yourself in a tough need. So we have a very simple way in which we help you figure this out. This is called the DIME. The DIME stands for debt or death, income, mortgage, and education. So DIME as an acronym. The DIME is going to help you identify how much life insurance you actually need to replace you or your income if you were to die too soon. And we can also figure how long you actually need that life insurance for, because you don't necessarily need it your whole life if you're building wealth as well. We're going to talk about this in an episode to come, but once you build wealth and you have that built, we show you how to continue to live, right? And therefore, you're not spending money on life insurance when you've already accumulated enough wealth to take care of your family. There are stats that are shocking. 49% of all working Americans in the United States do not have life insurance outside of their job. That is scary. Nearly half of the people out there are walking around not protected. 70 to 74% do have life insurance, but they're underinsured. They have small policies. No one sat with them. No one told them how to calculate their insurance need. No one talked to them about the dime, and therefore they have a huge need if something were to happen to them. Even though they have life insurance, they don't have enough. And so we talked a little bit earlier about different life insurance. Warren asked about the different types of life insurance, and there are policies that are not good for you. Remember this: life insurance policies are contracts. These are contracts that are written by attorneys that work for the life insurance companies. So initially, when you hear about a whole life policy or a universal life policy, conceptually it can sound good, but contractually is where the wheels fall off, because the contract, which is the most important thing, not the sales presentation, not the 5-minute sales that the guy gave you, it's the contract that you actually signed. And so when that contract begins to live up to what's actually written, and you begin to not have the benefits that you were promised, that's where the real tough part comes and the real problem. And so if we take a look at the dime, easy way to figure that out, right? So again, debt, income, mortgage, education. I have a friend who makes $50,000 a year, right? So in that, to replace his income 8 to 10 times, we're looking at $500,000, right? That's the income portion. We talk about the debt, right? Or the death. So if there's any consumer debt, now we're going to also have to control that. So there's $20,000 in consumer debt. And then we take a look at the mortgage, right? What's the mortgage balance, right? So there's $235,000 remaining on that mortgage. That needs to be taken care of. And then the education, right? You have a kid and you want that kid to go to college. Well, when you lose one of the incomes, it makes it real hard for that remaining parent to save. Therefore, we're going to replace that. So how do we do that? Typically, we do $50,000 if the child is of the age of 9 or below. If they're above that, now we got to do anywhere from $75,000 to $100,000 to pay for 4 years of college. So that can add up. So we're looking at $500,000 for the income replacement. We're looking at $20,000 in consumer debt. We're looking at $240,000 in mortgage cost, and we're looking at $100,000 for college. Pretty expensive. So if we take a look at what that insurance need is for the friend who makes $50,000, is $1 million insurance need. So it makes it very, very expensive to go with one of those other type of policies because they're so expensive. But with a term policy, he'd be able to do that, be able to afford that, as well as continue to build wealth. At the end of the day, it all comes down to what you know and what you do with that. Knowledge is not power. Applied knowledge is power, because the reality of not taking action on the things that are important does not give you any power. You must take action. Now let's move into a real life example. A client of mine who we're going to call her Iris, right? And so before becoming my client, she was sold a life insurance policy that was supposed to help her build wealth. She was spending $235.50 a month for $350,000 worth of life insurance. She had a 9-year-old daughter, and she was looking to really build and establish wealth. So we talked to Iris about her policy, took a look at it, read through it, and then I asked her if she'd be willing to call the insurance company with me so that we can ask them some very specific questions and gain some clarity on what she believed she had, what the agent told her, and what the actual contract read. And so this is how the call went. So we called the insurance company. She gave them her name and policy number. She stated that she had some questions about her coverage and that she wanted some answers. She also indicated that she had a financial advisor on the line as well, and she wanted for me to ask the questions. And they asked who I was and asked her to give her authority to authorize me to ask questions on her behalf, and she did. And so here are the questions. First question: How long has she had this policy? The answer was she got the policy in October of 2022. Next question. What is her monthly premium? Answer, $235.50. How much has she paid in premiums so far? She's paid $5,181.86. Next question. She was told that she'd be able to borrow money from this policy. How much money is she able to borrow today? Right, is what they answered. She has cash value, but has not accumulated enough that she'd be able to borrow from the policy. Next question. So how much does she have? The answer, she has $1,309.47 in her cash value. Next question. So she's unable to borrow any of that. The answer, that is correct. She currently is unable to borrow money from the policy. Next question. She has put over $5,000 in this policy and she's unable to pull any of it out. Answer, that is correct. She was told that she'd be able to borrow money within a short period without any tax consequence. Was that a misunderstanding? I do have another question. What is her target premium? Answer, her target premium is $389.16. So right now, she's only paying $235.50. What will happen if she doesn't start paying the target amount? The answer, the policy will fall behind and eventually lapse. Iris was, without saying, she was floored. She didn't understand how she was told one thing, that she'd be able to borrow money against this policy very quickly for a down payment. She'd be able to then utilize that money tax-free. And when we called the company, she found out that the policy that she has is not the policy she thought. The way that it was written, the contract that she signed, she's not paying enough on monthly. So therefore, she's really not going to be able to build cash value. And she currently can't borrow any. And if she doesn't start paying the target premium, which is close to $100 more, the policy will eventually fall behind and lapse. So she was devastated. But good news, we were able to help her. We were able to get her in a term policy, investing the difference, and now building a real wealth account in mutual funds. If you have a policy like Iris, maybe it's like hers, maybe it's not, I will review that for free. We'll take a look. Touch base with me. We'll be happy to sit down with you, make sure that the policy that you have is the policy that the agent told you you had, right? We're going to read that contract. Remember, it's the contract. It's not the sales literature that the agent gave you. It's not what he says. None of those things are enforceable. But the contract itself that you signed, the policy, is what's going to determine what you have. And I'd be happy to look at that for you. All right. So let's talk about free, right? Let's talk money truth, right? We're going to talk about what life insurance is and what life insurance isn't. Life insurance is not, has not, and will never be a place to invest money. Life insurance is, remember, to protect your income in the event that you die too soon. Take a look at the IRS website and search life insurance investments. You will see life insurance is never to be considered an investment. That is stated on the IRS's website. All right. And so to clarify, life insurance is to replace your income in the event that you die too soon. It is to protect your family, replace your income, very simply. That's all that it's for. And so if you'd like to learn how to get out of the need of having life insurance, well, that's going to be our next episode. We're going to talk about the ABCs of investing. So make sure that you like, subscribe, and share, because we are getting the word out on how money works, and we want you to get every bit of what this information that we're sharing. Let's build that wealth. Again, remember, this is the Wealth Initiative, a place for forward thinkers to ditch the status quo and build real wealth.